Myself, Suman Rangar. I would like to welcome you to the third episode of our highly anticipated DeFi series webinar. Today, we delve into the fascinating world of decentralized finance and explore two vital pillars: decentralized exchanges and lending protocols. Dr. Ravi Chamria, who is a renowned expert in the field of blockchain technology and decentralized finance, will lead the webinar, and he will guide us through the compelling use cases of decentralized exchanges and lending protocols within the DeFi landscape. Get ready to gain valuable insights as Dr. Chamria shares his expertise and thoughts on the present and future of DeFi. So, without further ado, let's join Dr. Ravi Chamria on this enlightening journey into the world of DeFi as we uncover the fascinating use cases of decentralized exchanges and lending protocols. Thank you.
Yeah, hi everyone. My name is Ravi. I'm the co-founder, CEO of Zeeve. Just a brief about Zeeve. Zeeve is a Web3 company. We have been in the market for the last 3 years. We provide Web3 infrastructure as a service platform that helps any Web3 startup, developer, or enterprise to deploy, manage, monitor their blockchain infrastructure. We support all the major protocols, including the large EVMs, substrate parachains, Cosmos chains, or any other chains like Near, Algorand, etc. So today, this is a continuation of our series. I'll just talk about, my assumption is that some of you must have already attended the first two webinars. In this webinar, we'll focus mainly on two of the major use cases in the DeFi world, which is a decentralized exchange and DeFi lending platform. Just to do a recap of what we covered in the first two episodes. So one was what exactly is DeFi, how decentralized finance differs from centralized finance, and what are the core constructs of DeFi ecosystem, whether it be blockchain technology, smart contracts, decentralized oracles, smart contracts, token standards, etc. And then, some of the DeFi primitives, different other components that enable somebody to build a DeFi app. So today we are basically diving deeper into two of the major use cases. There are quite a few use cases within the DeFi. DeFi is pretty much touching all the traditional financial products that we see, whether it be asset management, lending, investments, trading, whether it be perpetuals or normal trading, margin trading, tokenization, and so on and so forth. So out of these two, let's start with decentralized exchange first. Now, I'm assuming that most of you are already aware of using a centralized exchange. Most of the folks today who take an interest, I think the journey either starts by downloading a decentralized wallet like MetaMask, or they set up an account on one of these centralized exchanges, whether it be Binance or Bittrex or Bitfinex or BitOasis. So that's how you start a journey. So now, how centralized exchanges work. In centralized exchanges, you go to the platform, you sign up, you complete your KYC AML checks, and post that you get access to the trading platform. And the whole trading platform starts by putting in some assets, either buying some assets if you start with zero asset, or you transfer your assets from your decentralized wallet to the centralized exchange wallet. And then, once you have the assets in your account, you can trade that asset with another asset. So let's say if you have 5 Ether in your account, you can use 1 Ether to buy USDT, or you can use 1 Ether to buy DOT or any other token for that purpose. And then you can continue to do trading. But the whole transaction starts, with you depositing a token or you buying a token in the exchange. And the actual token resides within the platforms, the centralized exchange platform's wallet. So basically the centralized exchange platform, they take custody of your assets. And whatever trading, whatever portfolio that you see is very similar to like what we see in the Web2 platforms. If you go to any stock market app or a online platform, so you'll see that you can buy or sell stocks, and everything is residing within your demat account. Very similar to that in the centralized exchanges, the actual digital assets are being custodied, are within the custody of the centralized exchanges platforms. And what you do is database entries. So whenever you want to take custody of an asset, you need to place a withdrawal request, and then based on the withdrawal processing, you will get the digital assets from the exchange platform to your wallet. So this is how a centralized exchange works. So centralized exchange per se is centralized in nature. Of course, it has got some very good utility, which is providing good user experience, but at the same time, you do not have the custody of your assets. So if the exchange goes down or something else happens, you may lose your digital assets. So that's where the whole concept of decentralized exchange comes in. That how we can create an exchange method, workflow or process whereby somebody can, trade in digital assets, still at every point of time have full custody of the assets at the individual level. So this is what a decentralized exchange is. It's a peer-to-peer marketplace that enables you to exchange and trade cryptocurrencies, and you can simply connect your decentralized wallet, and then you can start trading here. So let's say in your wallet you have 1 Ether, you can say in the trading window that I want to take USDT, exchange USDT against the 1 Ether, and then the whole transaction will take place. 1 Ether will go out of your wallet and USDT will come back. And here, one of the primitives that we talked about, the whole atomicity piece becomes very critical here. So if by any chance or due to any reason, if you're not able to get your USDT against your Ether, the whole transaction will be reversed. So smart contracts ensures that your asset is always in your custody. So there are no intermediaries which are required. There are different players. We'll talk about how a typical decentralized exchange works. But it cuts down quite a few intermediaries that typically we see in a centralized platform. Somebody has asked a question. I'll take up the question while during the presentation itself. And since decentralized exchange platform is a DeFi app which is based on smart contracts, it is there's an underlying blockchain protocol. So there is a complete transparency on all the transactions that take place. So you can see all the transactions on the ledger. Everything is posted on chain. So just by using a wallet ID, account ID, or transaction hash, you can actually see the set of transactions which have taken place. Now, how decentralized exchange work? So the earlier decentralized exchange, worked on a very simple model. So if you talk about centralized exchange, they work on an order book mechanism. You place your buy orders, or somebody would place sell orders, and there would be a matching between the buy order and sell order. Let's say I have 1 Ether and I want to buy USDT, and the current price of Ether is, let's say, 1600 USDT. So then I can place a buy order, and then similarly there would be a sell order. Somebody would like to sell USDT and get Ether. So similarly, there are multiple buy orders and multiple sell orders. So this creates an order book, and then order matching happens. The initial DEXs typically worked on the same order book mechanism, and but the thing was that the idea was to have, rather than using a centralized exchange where everything is happening within a database and centralized exchange is holding the custody of the funds, rather than that, everything is happening on chain. So this process is basically a process which is order book based, and then we'll come in later. The most established model today is the automated market maker model, the AMM model. So in this case, a maker creates a new order, maker signs the order with their private key, and then they send it to the ledger, and then taker will take the order, sign it, smart contract will validate it, and then the funds are transferred between the two users. So this again is based on order books, and that's why it's called an order book based DEX. And there definitely would be some kind of fee that would be levied on each transaction. The fee goes to the platform. So then platform has an incentive to continue to manage, maintain, and run the platform. If you see differences, to summarize what we have, I just outlined. So in centralized exchange, of course, the user does not hold the custody of funds. The complete control is within the platform. Vis-a-vis that, in a decentralized exchange, you as an individual has got complete custody of your assets and you have the most control. In centralized exchanges, of course, there's a risk of hackers, security from a platform perspective, which is quite robust in the case of decentralized exchange. But yes, in decentralized exchanges, if the smart contract has not been designed properly or has not been audited properly, there may be security hacks at the smart contract level. But the underlying blockchain protocol ensures the security at the network level. Centralized exchanges are more popular, and I think the reason primarily being because it gives you the same experience that we are used to in the Web2 space. So that's why it's a natural extension. You simply go, you do a social login or normal login, there's a KYC process, and you can start trading. So because of its better UX UI experience, centralized exchanges are so popular. Decentralized exchanges are gaining popularity now, but yes, still people are not that comfortable. Not everyone is very comfortable managing their own private keys. And then, there's a fee charged in both the cases. In centralized exchanges, also there's a fee charged. In the decentralized exchanges, there's a choice of the platform, whether what kind of business model they are working on. Some of the platforms like PancakeSwap, they do charge a fee, and that fee is then shared with the people who are providing the liquidity. And then rest of the centralized exchanges adhere to regulations, and like for example, Coinbase is a listed entity in US, which is a cryptocurrency exchange. Decentralized exchanges, still regulations are being formed right now. Till the time there are proper regulations, of course, DeFi will take a bit of time to take off. But overall, from a concept perspective, there has been a huge validation. There are billions of funds which are logged into DeFi platforms today. And there's a huge amount of liquidity surge across different platforms. Arbitrum, Polygon, Ethereum, these are some of the protocols which are leading the way in terms of total liquidity logged into these protocols. So now going deeper into decentralized exchange, as I mentioned, order book DEX is what we saw on the previous slide, where there's a maker, taker, or buyer, seller, and then they execute a trade based on matching the trade. And if there's not a matching trade, then trade will remain idle. It will not be matched or executed. And then we have automated market makers. So today, if you see PancakeSwap or Uniswap or any of the major DEXs, they use automated market maker concept. And we'll come to that why AMM became very important. And then there are DEX aggregators. So aggregators basically aggregates different decentralized exchange platforms, so that if you go to an aggregator like 1inch, so you can place an order, and then 1inch will give you, it will fetch the best pricing options for you from different decentralized exchanges. So basically these aggregator platforms are aggregating different decentralized exchanges. Some of the popular DEXs like PancakeSwap on Binance, and then Uniswap on Ethereum ecosystem, Balancer, KyberSwap, DeFi.DEX, these are some of the decentralized exchanges. And they started with one chain, but now most of these exchanges have become multi-chain. So you can use Uniswap on different chains now. An example of automated market makers like Uniswap, SushiSwap, PancakeSwap. So most of the popular Bancor, Balancer, these are all most popular decentralized exchanges which are based on AMM. Now, how AMM model works, so AMM model works on a liquidity basis. So what is the challenge with order book matching system? The challenge is that you may place an order and you may put a limit order. By limit means that you want to hedge your risk. So let's say you want to buy USDT against your Ether. You have an Ether, the current price of Ether is 1600. And when you place the order, let's say at that point of time, there's no seller who is selling at 1600. Now there may become a seller later on who may be willing to sell at 1500. But you would like to ensure that you do not get any price below 1600. So there's an option where you put a limit order. That means that if the price is 1600 or more, then only the order will be executed. Similarly, the seller also ensure they may put a sell limit orders to ensure that they get the best price. So the challenge is always that the trade options, the with limits, etc., whatever parameters have been set by buyers and sellers, they may not match. So that gives rise to a lot of orders not being executed, hampering the whole user experience. And sometimes since today we have thousands of cryptocurrencies, and if we talk about even the most popular, there are still 100 plus tokens which are very popular. So if there are not buyer and seller depending on what pair that you want to choose. For example, you want to buy USDC against Ethereum, but if there is no seller for USDC, then your trade is not executed. So these are some of the challenges due to which liquidity get hampered and a lot of trades are not getting executed. And that is the reason why the whole concept of liquidity pool came in. So idea of pool was that there are liquidity providers who can put in money into a pool. So there's a common pool where there are multiple tokens. And then somebody wants to put a buy order or sell order, they can use this pool to execute the order. So now it's not one-to-one matching between a buyer and seller. Now both a buyer and seller are dipping into the liquidity pool and then getting their trade executed. So that way you see the trade executed instantaneously, and at the same time it resolves all the liquidity issues, and the user experience also become much better. In fact, now this has become the most common way of designing a decentralized exchange. So now, what are the market makers work on the liquidity? So liquidity providers are the very important component, and there's an incentivization structure. So whenever liquidity providers who provide the liquidity into the pool, whenever trade happens, substantial portion of that trade fee or transaction fee is passed on to the liquidity providers. So they see their asset base growing. And today, in most of the AMMs, the liquidity is provided in pairs. So if there may be Ethereum USDT pair or Ethereum USDC pair, or it can be Matic USDT pair, and so on and so forth. So liquidity is provided in pair, and based on trades which are placed by different buyers or sellers, the trade is executed using the pool. Now, how the mechanism works from a liquidity provider: whenever you provide liquidity into a pool, you will get liquidity provider tokens called LP tokens in return. So LP tokens are like a receipt that you have provided so and so liquidity into the pool. And whatever transaction fee you earn as a liquidity provider, that gets accrued. And whenever you give the liquidity LP tokens back to the smart contract, you can get your original assets back. So that way, in a very simple, high-level manner, that is how the process works. And now with Uniswap coming up with version V2 and V3, you can set more complex parameters, decide when the trade should happen, within which range the trade should be executed, etc., so that you can maximize your transaction fee. Now, coming to DEX aggregators. So one of the challenge in decentralized exchange is slippage. So slippage is a bit complex phenomena. So since the liquidity in decentralized exchanges is provided in pairs, so whenever the pair get disturbed, in the sense that if there are suddenly a lot of net buyers of USDT and people are selling Ethereum and buying USDT, when such a scenario happens, then the liquidity of the pair within the pool that get disturbed, and due to which there may be a slippage, and slippage may lead to a loss. So there's a loss that can happen. So to avoid that, different DEX aggregators are there, because liquidity keep on changing from platform to platform or protocol to protocol. There's a huge competition when liquidity is concerned. So DEX aggregators become a safe bet in that case. If you talk about Uniswap, PancakeSwap, they have huge liquidity because they are the most popular platforms. But there are some new platforms that come up with a very limited liquidity. So DEX aggregators basically, help you compare the trades. Whenever you place a trade, you can use a DEX aggregator, and that will give you multiple options. You must have seen, if you have tried doing a swap function on MetaMask wallet, there also you'll get options. It will show you which underlying exchange is giving a better option to do a swap. So in decentralized exchange, swap is a common term because you are simply exchanging one token with another token. So there are common platforms like 1inch and Matcha and TerraSwap, etc., which are basically provide complete decentralized exchange, and they, as you can see, they can support multiple chains, and multiple they pull in orders or aggregate orders from various decentralized exchanges. So what are the benefits using of a decentralized exchange? So one is, of course, security. By security, we mean that you hold the custody of your funds at all point of time. So there is not going to be a scenario like in the case of FTX, the funds of the users, which actually were the liability for the platform, they were being misused, because normally the centralized exchanges say that their business model is to make revenue out of the transaction fee. And whatever assets they are holding on behalf of the customers is something that they should not be misusing or using somewhere else. If they are using that, it should be explicitly exposed or conveyed to the customers. But so FTX kind of scenario happened. That is the benefit of decentralized exchange, that it's completely smart contract driven, and there is no centralized entity which is holding custody of your assets. So that way it's very secure. And then there's a privacy. The transactions are completely open, but there is no KYC, etc. It's completely driven through a wallet. You can simply connect your wallet and you can start doing transactions. So it does not ask for your real world identity to do the transactions on a decentralized exchange. And then it is censorship resistant, all the tenets of a decentralized application built over blockchain. Trustless, and there's of course a low fee. Wherever there's a bigger liquidity pool, more liquidity providers, it leads to a lesser fee, and more competitive trading can happen. But what are the risks? Of course, there are some risks using a decentralized exchange. One, as I mentioned, the biggest is the poor liquidity. So liquidity can lead to slippage and other, user experience that the pool is not able to execute your order. So those kind of liquidity issues still remain, but not in the bigger exchanges, but smaller exchanges, new exchanges that they launch. The second, smart contracts for quite a few decentralized exchanges have been exploited over a period of time. Now the market has matured a bit, in the sense that now smart contracts have matured. People are getting it audited through multiple auditors. They are doing continuous monitoring of the security monitoring of the smart contracts, so that nobody could be able to exploit these vulnerabilities. And then token bridge is another, because as you see, most of the decentralized exchange now are multi-chain. But the challenge with multi-chain is that still quite a few chains for interoperability. Let's say you have USDT on Polygon and you want to shift it to USDT on Avalanche or Ethereum. So then typically people use cross-chain bridges. Again, cross-chain bridges have been, they are completely based on smart contracts, and a lot of hacks have happened as far as cross-chain bridges are concerned. Now better interoperability platforms are coming in who are solving this. In fact, some of the players are coming up with this, the whole liquidity licensing across different chains, how to bring in liquidity from one chain to another very easily, using very secure methods rather than using cross-chain bridges. And then, there are MEV watts, which are maximal extractable value, or arbitrators who can, basically take advantage Like, for example, there's a front-running problem. That is a typical problem because blockchain being open, all the transactions that are being placed, they can be seen by the validators. And validators, based on using MVP bots, they can choose to commit some transactions, or further trades can be facilitated based on the existing trades. So these kind of front-running problems could be problems. There are a few options now where privacy of transactions are bringing in, where the front-running may be avoided using privacy of or encrypting the data in such a way that they would not be able to see the actual data. And then, typical issues that we used to face during congested times, Ethereum network getting congested and suddenly the gas fee has gone up. So since you are doing a smart contract transaction on a decentralized exchange, you'll be spending gas. So you're signing the transaction, you're spending gas, or you're doing the actual trading transaction, you're still spending gas. Sometimes, the gas fee itself become very high. And if you're doing a smaller trade, let's say trade worth $500 or $1,000 or $2,000, as a percentage, the transaction fee and gas fee may become substantial. And then, of course, decentralized exchanges being new, there may be scaling issues. But yeah, again, scaling issues are now being solved by some of the third generation blockchains who are promising transaction throughput of 5,000 transactions per second or 10,000, even more. So a lot of scaling issues are, but yeah, these are some of the challenges that we still see in quite a few decentralized exchanges. So this was on decentralized exchange. I'll quickly take up the question. So the first question is, why hasn't DeFi gained widespread acceptance despite its immense potential? So yeah, so right now DeFi, as we see, has seen a huge traction, but it's still a small market as compared to the overall larger market. And it's mostly being used within the crypto community who are very comfortable using their decentralized wallets. The second, so user experience is definitely one reason. As people get more comfortable using wallets, they will start getting more comfortable using different decentralized apps, DeFi being one of them. Second is regulatory challenges. So we have seen till the time, there's a proper regulatory framework for DeFi to operate, we are going to see a lot of disruption. Because from a process perspective, from a tech perspective, it is very clear that we are cutting down a lot of redundant processes, a lot of low value driven processes today that happens in exchanges. And that's why this whole concept of DeFi is now being seen not just for building crypto exchanges, but different kind of trading platforms. So it has got a, and still, sometimes in a bearish market, the total value log becomes less, but DeFi has been growing steadily for last 2 to 3 years. One question is, can we have exchanges which are hybrid of centralized and decentralized? So my assumption is when you say a hybrid, then you're talking about that, let's say the custody, etc., everything is decentralized, which are important critical factors for the users. But from a regulation perspective, can we bring in, let's say, decentralized identity, which is mapped to a real world identity, so that compliances can be met, like who all are trading, etc. So yes, that can be done. These kind of hybrid systems are being designed today for tokenized assets. So now DeFi, was mostly covered using stable coins or utility tokens like Ethereum, Matic, USDT, etc. But now, since on the other hand, when tokenization of real world assets is picking up, so a lot of these tokenized assets are now coming on the DeFi platform to get traded, and these tokenized platforms may have restrictions based on compliances as to who all can participate and buy these assets. So their decentralized identity combined with some compliance contracts can ensure DeFi to grow further, provide a good user experience. So yeah, so these kind of exchanges are also being thought of now. There may be other features that may be part of this hybrid, but compliance, I think, is a very strong use case to bring in compliances into the current decentralized exchanges, so that a proper regulatory framework, or they can operate within a proper regulatory framework. Now, the second area which is very closely related in terms of process or liquidity pool perspective, is the whole DeFi lending piece. Lending, as we know, Aave, Compound, these are some of the leaders who started the whole DeFi lending. So DeFi lending, what we see, lending and borrowing, traditionally we have seen there's a long drawn process in borrowing funds. In crypto, what happens is, let's say you have Ether, that is like your collateral, right? And you have need of funds. So you can go to a DeFi lending platform and you can take funds, putting your Ether as a collateral. And whenever you give back your funds that you have borrowed, maybe you have borrowed USDT against Ether or any other token, once you return that token back to the smart contract, you will get back your original collateral, Ether as a collateral. So that is what, in a nutshell, that DeFi is solving. It's a collateralized lending. Now, a few startups have come in who have also providing non-collateralized or uncollateralized lending. But today we are talking mostly about collateralized lending. This is how most of the platforms like Aave, Compound, etc. works. Again, like decentralized exchange, a DeFi lending platform is completely smart contract driven, is a completely decentralized. You simply connect your wallet. You can be a liquidity provider. So there's the liquidity pool out of which people are borrowing or they are lending. So lenders are people who are liquidity providers, putting funds into the pool, and borrowers are people who are borrowing against it. And like, traditional finance, borrowers will pay an interest, and a substantial portion of that interest goes to the liquidity providers or the lenders. So this is how, a lending pool works. It's like a smart contract based pool where on one side there's lender or liquidity provider. They are putting in the funds into the pool. And on the other side, there's a borrower who will connect the wallet and then put in a collateral and take the, and there would be different rates based on the, so there are a few concepts I'll discuss about. So each pair that you choose, let's say whether you want to take USDT against Ethereum or you want to take another token against Ethereum, how much collateralization is required? Like, for example, let's say you have one Ether, or you have Ether worth $1,000 and you want to take USDT against that. Based on the collateralization ratio, you may at the max take 700 USDT. So 30% additional or extra collateral which is being put into the smart contract. If the liquidity of the pair overall in the market is less, then this collateralization ratio may be even higher. So you may get only $600 worth of tokens or $500 worth of tokens. So the collateralization ratio, maybe 150% is typical, but then it may be 200% or even more. That is one of the major drawback of these platforms. But as you know, today the whole crypto economy is very volatile. Most of the tokens are very volatile in price. So it is to safeguard that you take additional. It's very similar to what we see in the traditional finance also. So the concept is very similar to that. Here also, if you see in residential homes, you get 80% of loan worth the value of the home, but in commercial properties, it may be less, depending on where the property is, how liquid the property is, the overall socioeconomic market situations, etc. Based on that, the loan amount changes, how much loan can be given against the asset value. The same concept is there based on the collateral value, how much loan you can borrow from the pool. And then, once you have taken the loan, let's say there's a price fluctuation. So let's say you deposited $1,000 worth of Ether and you have taken $700 worth of token as a loan. Now, if the value of Ether goes down, the collateral that you have put in, then it may not be $1,000 worth of Ether anymore. It may be $900. So there is a limit which is defined that if it, let's say, hypothetically, if it goes, the value of Ether goes below $900 that you have put into the pool as a collateral, then in that case, you need to deposit more Ether or you need to return portion of your loan to ensure that your collateralization ratio is maintained. If that also doesn't happen, then there are third-party liquidators who can liquidate your position, and they can sell your ether, and then you already have got $700 worth of ether. There would be a penalty or fee that the liquidity providers will charge, and rest of the amount will be credited to you. So they can liquidate the position and close the collateral. So again, very similar to what we see in the traditional finance, but the difference is that in this case, it is completely smart contract driven. Everything is very transparent, and there are business logic, and the smart contracts abide by them. Again, from a business model perspective, the borrowers pay an interest. So one, you're putting in more collateral. Second, of course, like in traditional finance, the borrower will be paying an interest on the amount they have taken as a loan, and substantial portion of that interest goes to the liquidity provider as an incentive for them to provide liquidity. Some of the popular DeFi lending and borrowing platforms are like Compound, Solent, which is on Solana, and then Aave being one of the largest that we'll talk about. So this is how Aave decentralized lending pool, and Aave was one of the leaders here. They started with At.the, a startup. So At.the was based on, it was a decentralized exchange, but it was based on order matching scenario. Vis-a-vis that, if you see, vis-a-vis, then it transformed into Aave, and Aave is a AMM based, automated market maker based. So there's Aave decentralized lending pool, and then as a borrower, you can take a loan, putting in the collateral. As a lender, you can provide liquidity, and you get an interest. And then now there are various variations of these platforms now. So as I mentioned, it started with At.the, which was like traditional lending put onto blockchain. But then people slowly realized that I think creating a liquidity pool is a very more efficient way of doing it, because as I mentioned, matchmaking between borrowers and lenders was a big challenge. And that challenge is there in the traditional finance also, and that translated into At.the kind of projects also. But with liquidity pool coming in, that problem was completely solved. So what are the differences between DeFi-based lending and traditional lending? One, in DeFi lending, it seems if you have taken a traditional loan, a personal loan, a home loan, a business loan, vis-a-vis that, if you see a collateralized secured loan on DeFi, it seems to be magical. You connect your MetaMask wallet or any other wallet, you have tokens, you go on, you decide on the pair, you provide your collateral, and you get your token, and that's it. It's over. And whenever, after 1 month or 2 months or 3 months, anytime you return back the assets that you have borrowed, your original tokens are secured. You get them back into your wallet. So it's a very simple process. It does not involve any paperwork, intermediaries, delays, etc. And then, it cuts down the overall number of steps also. So there's a transaction efficiency. There's a transaction cost also gets reduced immensely. And that's the reason, tokenized assets is also seeing DeFi. With tokenized assets coming into the picture, the whole DeFi lending will also increase. As I mentioned about decentralized exchanges where people can buy and sell, but with lending, mortgages may itself be revolutionized. Just imagine a scenario where you have, proper, compliant, tokenized assets which are tokenized against real estate. Then you can take a loan against those assets. So it becomes very much, it will be like replacing the existing mortgages. And then DeFi lending, ensures, there's a blockchain-based system. So there's an immutability, there's a transparency of transactions which are there. And best part is it's financially inclusive. So from wherever in the world you are, you connect, you have the same experience, same rates. There are no difference based on geography or exchange rates or kind of currency you are dealing with, and so on and so forth. And then, there are various additional options that, there are margin trading options, or long-term lenders have a good chance to lock or lend their assets in a higher interest. There's another concept which is liquid staking, which again, people are using in the lending platform. So there are a lot of innovations happening in the whole DeFi lending and borrowing space. So if you see a traditional system, there's a user, there's the intermediary banks, then, there may be settlement platforms, it may be the cards or Swift, or depending on whether it's a domestic transaction, credit card transaction, or international transaction. Vis-a-vis a decentralized finance system, it's a directly user to user. And there also you are not getting into matching. You can simply use the liquidity pool to transact. So benefits, again, it's a completely pseudonymous platform. You just require your wallet to connect and use the DeFi lending platform. There are no approvals, etc. There are simple rules that, again, smart contract driven. And most of these platforms today, Uniswap, etc., are driven by DAO. So what kind of rates they are going to charge, what kind of collateralization, etc., is completely community driven now. And what are the risks? So risks are pretty much on the same line of what we discussed about decentralized exchanges. So there are risks related to smart contract hacks. There are risks related to regulatory compliances. There are risks related to rug pull schemes. A lot of because what happens is a lot of DeFi platforms come in, and some of them promise, because these DeFi platforms come up with a token, there's a huge promise that they would be able to get decent amount of liquidity and the value of token will go up. But then, sometimes that doesn't happen, and they have raised funds, but they do not have sufficient liquidity, and then they close down, or they use, different kind of schemes to misuse the funds of the users or investors. So those kind of challenges still remain in the DeFi world. But yes, as incidences have happened, people have become wiser. People now understand, and there's no point in investing into a new project for which you do not have clarity on who the team is, what kind of technology has been used, what kind of investments, or some kind of validation, the typical due diligence one should do before getting into any of the DeFi apps. And then smart contract vulnerability is definitely an issue, and scalability, of course. But as I mentioned, scalability is being improved as the underlying blockchains, the whole layer 2s, app chains. There are a lot of technology innovations which are happening with different blockchain protocols to ensure that the main chain like Ethereum continue to provide decentralization and security, and at the same time, layer 2s like Polygon can ensure high throughput, better scalability. So, to summarize, there are all different kind of financial products that we see are being built into DeFi in a DeFi fashion. Today we talked about decentralized exchange and DeFi, but you can see a lot of investment related DAOs have come up. There are a lot of platforms which allow you to manage your portfolio. There are a lot of infrastructure products. So there are quite a few categories. You can check out some of the platforms like DeFi Prime, where you can see all the different categories and different players, different startups in each category. Insurance, again, is something right now restricted to just the smart contract hacks, but then, decentralized insurance is an area which is again picking up. So yeah, so this is all about DeFi today. Any questions anyone has, we can take up that. So if you do not have any questions, so that's all for today. If you have any questions about how Zeeve can help you build your DeFi app or go to market faster, build your application faster, do connect with us. We are available on Twitter, LinkedIn, Discord. And if you have any questions you would like, you can connect with me on LinkedIn or Twitter, and I would be more than happy to answer all your questions. Thank you. Keep smiling, keep building.